the human nature of having interest rates that low from that long and the reciprocity of shooting rates up the fastest pace in history. If you look at it on a log normal basis, it is. On a global basis, all these central banks, it's just, I think it's irrational to not expect normal reciprocity in markets and in what's happened with what people have done um, during that low interest rate period. So that's why I'm looking for one of the most significant economic resets of a lifetime based on normal cycles. And that to me is a key part of it.
If the United States defaults on its debt, risk assets will fare poorly, according to senior commodities analyst at Bloomberg Intelligence Mike McGlone. Risky assets are likely to increase once a deal is reached to raise the U.S. debt ceiling, according to the strategist for Bloomberg. According to McGlone, the debt ceiling will most likely need to be lifted as a result of the market's response to a probable U.S. debt default. Small losses were experienced by the majority of commodities indices as a result of persistent worries about economic development, brought on by the March regional banking crisis and bank failures. In April, both the Bloomberg and UBS constant maturity commodity indices, cmci and com, respectively, saw declines. The sector that performed the worst for the month was industrial metals, which fell by more than 3%. Investors are concerned that a credit crisis brought on by the banking failures will weaken the economy and cause a decline in the demand for industrial metals. Each of zinc and copper had declines of almost 8%, adding to the sector's overall losses. McGlone provides a macro forecast on the job situation, interest rates, deflation, and the inevitable occurrence of a recession in this video. As you watch, don't forget to subscribe, like, and leave comments in the space below the video.
My base case is we will go down that 20% in the equities, regardless of the oxymoron of default in U.S. government. That should never be something to be said. Maybe it'll be a delayed payment, but it'll all be worked out. And everybody will get their U.S. dollars. They may print more, but we are seriously tilting towards a recession. The Federal Reserve is still tightening, and the job warning out of Fed governors is significant. You cannot, don't fight the Fed has been one of my main mantras for well over a year, and it still is. That the key dichotomy you see is Fed fund futures price from right now to the end of the year, about 70 basis points of cuts. And virtually every economist, our chief economist, Anna Wong, our chief strategist, Ira Jersey, and most of the Fed governors said, we're not going to be cutting rates. Saying that, it means there's only one way for that really to happen, for the futures market to be right, and that is for the stock market to go down and make it happen, unfortunately, which might be led by Bitcoin. So the situation we're in right now, I see as mostly risk, lose for risk assets, and you're seeing that in commodities. There's significant deflationary forces showing up in commodities. So I look at the politics are all part of it. To me, it's the most overwhelming macro is that it's May. We just had a Fed hike. We've had 2 Fed hikes despite this banking crisis. And this is the kind of thing I think we're going to look back from the future and say, okay, well, we probably should never do that again because what resulted was a significant depression, maybe recession. It's a key thing. Now, I say that. I don't like to say it as McGlone has been my nickname I've earned, but just point out the facts of liquidity and history, which I love getting on your program. We've never had a pump in liquidity like we've had up to that peak of money supply around 26% in 22, down negative now. Never had that. And we've never had the dump like we've had now in terms of not only just money supply, but you're seeing it in bank deposits receiving. And just the lessons of history say we should expect some form of reciprocity in economic activity. Not complicated at all. So that means in the stock market, maybe just a normal 50% peak to trough correction. We've had that in the last 2 recessions. The key thing is in the leading markets, it's already happening, Michael. Like if I look at the most significant measure of heat, electricity, and fertilizer in this country, natural gas has dropped to the same price as 1990. Significant deflationary forces. The Bloomberg Commodity Index is down 24% on a 1-year basis. Copper has just broken down in the year, pumped to 12%. There's still these little things. So I look at politics and everything. Yeah, the debt crisis is a pretty significant tree, but the forest is that we are tilting down towards a severe recession, hasn't even started. And all the indications are right now, key question I'll leave you with is there's nothing I see on the radar at close that what can stop this downward trajectory at the moment. To me, the base case from a year from now is we will be in severe deflationary situation. And it's already happening in commodities. I pointed out it's happening in yields, already pointing that out. It's happening in virtually every indicator I look at. You look at, here's one key fact. The producer price index around 2% now, last year's peak was 18 or so, is dropping at the fastest pace in history. And that goes back to 1948. Now that's got a 2 beta to CPI. Typically it runs ahead of it. If CPI is running 5%, PPI is usually 10%. It's a 2 beta. It's going to be negative. When we print the June number on July 13th, and it might somewhat mimic the lowest level ever, which was from July 2009 at 6.9%, because it's the measure. Crude oil peaked the year before, and it bottomed that during the measuring period, and it's just what happened. The Bloomberg Commodity Index in crude oil peaked in June of 2020 of last year. When we measure PPI for June of this year, it'll be from the absolute peak. It'll be a negative number. If not, it'll be heading towards severely negative. So that's significant deflation. So let's take PPI minus Fed funds. It's negative. It's negative like 2.5%. It's seriously contractionary and recessionary. So here's the way I look at it, Nose. All my indicators, everything I look at are showing towards severe deflation. I can point out, like I mentioned, commodities are down 24% on an annual basis. Copper's just broken down in the year. It was up on the year. The Fed bank, we have a bank crisis. We had money supply contracting. Number one thing that Ben Bernanke pointed out when he wrote his essays on the Great Depression, there's one key measure that's on the cliff's edge for deflation. That's the stock. So I think what's going to happen, risks of predictions, is the S&P 500 was right around 4 bid. I look at it as 4,000 bid. It's just going to go 4 offer and go down to 3. Now I say that I use these signals because I remember that in the trading pits. You'd see markets trading 1, 2, 1, 2. Gold just was offered at 2 for years, and it just went 2 bid. And I think it's going to end up going 3 bid. I just see that happening with the fundamentals. The stock market, now the S&P 500 has been hovering around this 4 level. It's 4 bid. And a lot of indications are saying it should go 4 off, and once it does, I think it drops to 3. In a normal recession, that is your basically on a 1 to 10 scale, that is everything kicking in at a 10 for severe enduring deflation. And here's one key fact I'll end with is the Federal Reserve will just never ease with the ease they have in the past because of the lessons they learned from easing too much and inflation that resulted. And we haven't even started this recession. So I think that's an unlikely scenario without significant Fed easing, and that's what's changed. So I like to point out what's different from a lot of people who say, oh, okay, once the Fed's done tightening, the stock market will do well. I remember that cycle in 1994, but you have to remember from where we came. We were just so expensive, the U.S. stock market. So I look at it as I was in the trading pits in the 80s. I remember the Nikkei peaked in 90. It still hasn't got above that level, the Nikkei 225. You look at the Euro Stoxx index in Europe, I think it's the same price from 23 years ago, something like that. I could look at it in a second. So to me, that's the key thing. And that's where I rope in what's happening in treasuries. I look at it, this is also cyclical, and it's part of what's happening with demographics. Every boomer on this planet, when they saw that 2-year note go to 5%, they said, thank you. I mean, if they did it, then they weren't advised well. And what happened, that was in March. And what's happened since then? So now it's offered at 4 at the moment. It's right around 4 yield. That's at 4 yield. I think it's going to go offered at 3, partly because we all realize, okay, we've had a great run. Time to check in and say thank you very much. And everything's tilting. I think we'd have to not get that recession. That's the highest probability since 1982 when you look at the yield curve. So here's another key factor. Look at unemployment. 3.2%, the lowest in how many years? Decades, 60 years or so? Yeah. There's never been a case of unemployment, and it's the stated goal of the Fed for unemployment to go higher. It's never been a case of unemployment prowling from such a low level without a severe recession, or at least a recession. And then I look at things like, why is the price of natural gas, the most significant measure of heat, electricity, and fertilizer in this country, dropped 80% and down to the same price as 1990. Why is copper giving it back all its gains? Those are indications on a global basis of a lack of demand pull. And what normally happens to commodities, humans create more of it for less. So I think good luck with that one. Sometimes people like that might not say exactly what their positions reflect for different reasons. You got to be careful with that. But I look at it, I'll end with this. I'm completely worried that crypto's the fastest horse in the race on the way down last year, and everything's been up this year. Like I said, copper's given back that up. Cryptos are starting to give that back up. Will be one of the first indicators of everything starting to tilt back downward. And what's the stated goal of the Fed? Keep rates higher until they can reduce the ability for people to buy stuff. It's not what they said, but it's kind of my interpretation. It's also what Jim Bianco has said.
Do you believe that the poor outlook for the global economy is related to the impending elections in the United States? Please share your opinions in the space provided below. Do not forget to subscribe, like, and enable notifications. Thank you for your time.